into new low territory where one would expect to trigger a wave of stop-loss orders, but instead, he finds a vacuum. The lack of selling pressure proves that the supply is exhausted, and the stock is ready to advance. The second type is the spring on high volume. In this case, the break below support does trigger a significant amount of selling from stop orders and panicked traders. The volume on the chart is high. This action is bullish because the price stops declining on this high volume and then quickly reverses to climb back into the trading range. The high volume was the effort of the sellers, but the result was a failure to produce a sustained decline. This shows that the Composite Man was present, and his buying power was great enough to absorb all of this final wave of selling. The quick recovery after either type of spring is the final confirmation that the maneuver was a bear trap and that a significant markup is now the most probable outcome. After a long period of preparation within the accumulation range, the stock is finally ready to begin its public advance, or markup phase. The event that signals this transition is the jump across the creek, a decisive breakout above the resistance of the trading range. The volume signature at this critical juncture is non-negotiable. A genuine, valid breakout must be accompanied by a substantial and sustained increase in volume. This is the direct application of the law of effort versus result. The breakout is a significant result, and it requires a significant effort in the form of high volume to be considered legitimate. This high volume is the proof of powerful, aggressive demand. It shows that the Composite Man is no longer buying quietly, but is now willing to bid the price up to force the breakout. It also represents the buying from other professional traders who recognize the technical signal, as well as the forced buying from short sellers who are now trapped. This confluence of demand creates the power needed to overcome the natural supply that exists at the old resistance line. A breakout that occurs on low or average volume is highly suspect, and is often a sign of an upthrust, or bull trap. It shows a lack of conviction and suggests that there is not enough demand to sustain the move. Following the initial breakout, the analyst must watch for the backup to the edge of the creek, BU, a pullback to test the old resistance level as new support. The volume on this test is just as important as the volume on the breakout. A successful backup to the edge of the creek must occur on a dramatic shrinkage of volume. This proves that the supply that was present at this level has been removed and that sellers are no longer a threat. This low-volume test is a final, powerful confirmation that the breakout is valid and offers one of the safest entry points for a long position. Once the markup phase is underway, the stock should begin to make a series of higher highs and higher lows. The role of volume analysis during this phase is to continuously confirm the health of the uptrend. A healthy, sustainable advance has a very specific rhythmic volume signature. Volume should expand on the advances and contract on the reactions. As the stock pushes to a new high, the volume should increase, showing that buying enthusiasm is strong and that the demand is easily overcoming any light profit-taking. This harmony between rising price and rising volume confirms that the trend remains in a strong technical position. On the subsequent pullbacks or corrections, the volume must noticeably shrink. This is the most crucial sign of a healthy trend. The contracting volume proves that the selling is not aggressive distribution from large interests. It is simply passive profit-taking from weaker hands, and it is easily absorbed. As long as this harmonious relationship between price and volume continues, expanding on the rallies and contracting on the pullbacks, the Wyckoff analyst has a strong logical reason to hold his position and let his profits run. The first sign that this rhythm is changing is a warning that the markup phase may be nearing its end, and that the next phase, distribution, may be approaching. Just as the principles of volume analysis provide a clear and logical framework for identifying strength and predicting uptrends, they serve as an equally powerful tool for detecting weakness and forecasting declines. The campaigns of the Composite Man are symmetrical. The same methodical patience he applies to accumulation at the bottom, he applies to distribution at the top. The same fundamental laws of the market govern both phases. Therefore, the Wyckoff analyst understands that every bull market must eventually end, and that the end is not a random, unpredictable event, but a logical, drawn-out process that leaves behind its own distinct set of volume signatures. This final section is dedicated to the study of these signatures of weakness. We will dissect the bearish side of the market cycle, from the topping process of distribution to the subsequent downtrend of the markdown, to reveal how volume provides the earliest and most reliable warnings that a major market advance is over. The first and most dramatic volume signature of a major market top is the buying climax BC. This event is the mirror image of the selling climax. It occurs at the end of a long and often accelerated advance, when public enthusiasm has reached a fever pitch. Greed is rampant, the news is universally positive, and the fear of missing out drives the last of the public buyers into the market in a final frenzied rush. It is this wave of euphoric, uninformed demand that the Composite Man has been waiting for. He now meets this demand with a massive wave of supply, feeding his enormous line of stock, which he accumulated at much lower prices, into the market. On a chart, a buying climax is characterized by a day of extremely wide price spread and a climactic or exceptionally high volume of trading. The price often surges to a new high early in the session, but then stalls and closes well off the peak. This is the ultimate sign of effort versus result disharmony. The tremendous effort, represented by the climactic volume, has failed to produce a corresponding result, which would be a close at or near the high. This failure to hold the gains proves that the buying demand, as powerful as it was met and overwhelmed by an even more powerful wave of selling supply. This is the irrefutable evidence that a massive transfer of ownership is taking place, from the strong, informed hands of the Composite Man into the weak, emotional hands of the public. This event marks the exhaustion of the market's buying power and signals that the uptrend is in grave danger. Following the buying climax and the subsequent automatic reaction, which is the initial sharp decline caused by the sudden influx of supply, the stock enters its distribution trading range. Just as with an accumulation range, the analyst must now meticulously study the interplay of price and volume within this new sideways channel to confirm that distribution is indeed taking place. The volume signatures here are the direct inverse of those seen during accumulation. The most important sign of a distribution top is that volume expands on the declines within the trading range and contracts on the rallies. An increase in volume on a sharp reaction shows that supply is becoming aggressive. The Composite Man is pressing his sales on the market. Conversely, when the stock attempts to rally back toward the highs of the range, the volume will tend to be conspicuously light. This drying up of volume on rallies is a critical sign of weakness. It proves that there is a lack of genuine professional demand. The buying power has been exhausted, and the public does not have the financial capacity to absorb the large blocks of stock being offered by informed interests. Another key sign is the repeated failure of the stock to make significant upward progress on high volume. The price may churn and show great activity near the top of the range, but it fails to move higher. This is another clear example of effort versus result disharmony. The high volume is the effort, but the lack of upward movement is the failed result, proving that the effort of the buyers is being completely absorbed by the supply of the sellers. This churning action is the very definition of distribution. As the distribution campaign nears its end, the Composite Man may employ a final manipulative maneuver to trap the last of the bulls. This is the upthrust. As the mirror image of the spring, the upthrust is a sharp price move above the resistance line of the trading range that is designed to fail. Its purpose is to create a final illusion of strength, encouraging breakout buyers to jump in and triggering the stops of any remaining short sellers. This final burst of buying provides the Composite Man with the perfect opportunity to sell the last of his holdings at the best possible prices. The volume signature on the upthrust is a critical clue to its true nature. An upthrust on low volume is a clear sign of weakness, as it shows there is no genuine demand behind the breakout. An upthrust on high climactic volume that fails to produce any further upward progress is an even more powerful sign of distribution, as it shows that the breakout attempt was met with overwhelming supply. In both cases, the confirmation of the upthrust is the price's swift failure to hold its gains, quickly falling back into the trading range. This confirmed failure is one of the most reliable signals to exit all long positions and to initiate short sales in anticipation of a new downtrend. Once the distribution is complete, and the stock is now primarily in the hands of the weak and uninformed public, the path of least resistance is definitively downward. The markdown phase begins. The volume signature on the initial break of support from the distribution range is critical. A valid breakdown or a fall through the ice must be accompanied by a significant and sustained increase in volume. This shows that the sellers are aggressive and that there is a powerful force or effort behind the new downtrend. A breakdown on low volume is suspect and may simply be a shakeout. After the initial breakdown, there is often a rally back to the underside of the old support line, which now acts as new resistance. This is the last point of supply, LPSY. The volume on this rally is a crucial confirmation. A test of the broken support on light, diminishing volume is a very bearish sign. It proves that buying power is absent and that the demand is not strong enough to push the price back into its old trading range. This point offers one of the safest, lowest risk opportunities to initiate a short position. During the subsequent downtrend, the volume continues to tell the story. A healthy downtrend, like a healthy uptrend, has a rhythmic volume signature. Volume should expand on the declines and contract on the rallies. The increasing volume on the downward waves shows that the selling pressure remains strong. The feeble, low-volume rallies show that there is no significant buying demand to impede the decline. As long as this pattern of volume continues, the analyst has a logical reason to maintain his short position, allowing his profits to run until the first signs of a new selling climax and a new phase of accumulation begin to appear at the bottom of the decline. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, complete with explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. In conclusion, volume is the ultimate tool for verifying price action and understanding the market's true intent. While price tells you what is happening, volume tells you the story of the force and the conviction behind the move. The genius of Richard Wyckoff was his ability to systematically read this force. He understood that a price move without the confirmation of volume is often a deception, while a move supported by a harmonious volume signature is a true representation of the dominant power in the market. By mastering the principles of volume analysis, by learning to read the climaxes, the tests, the breakouts, and the trends through the lens of effort versus result, the student learns to see the market as the composite man sees it. He learns to detect the quiet work of accumulation and the noisy advertising of distribution. He learns to read the logic behind the market's every move and to align his own actions with the dominant force, whether that force is bullish or bearish. This is the essence of the Wyckoff method.